Hey, welcome back, stackers, collectors, and investors in precious metals. I'm the Florida Stacker, and in today's video, we're going to talk about the gold market and one of gold's natural enemies, really, and that's the government-issued treasury bond. It's gold versus paper in today's video, so stay tuned. Let's talk about it. Hey, and welcome back, YouTube stackers. Welcome back, everyone. So before we jump into the details of the beautiful gold and silver laid out before you, it's important to note real quick that while I offer my viewpoints, a little bit of financial education, but mostly just opinions, I'm not a financial advisor, folks, so please be sure to do your own due diligence before investing. However, we need to talk about government-issued treasury bonds or interest-bearing IOUs, and also one of gold's most fierce competitors in the safe haven segment of a financial portfolio. Of course, us stackers know what the paper traders can never fully understand. Paper traders deal in digits only on a monitor screen or maybe just some scribbles on some paper somewhere, whereas stackers understand gold's true value. We know it's much more than just its dollar equivalent. Yes, I'm talking about what makes gold the true king in fighting currency devaluation, as well as government malarkey. It's its physical sense of self. It's the fact that it's physical. You can touch it, you can hold it just as I am right now. It's not just a ledger, it's not just a scribble, it's not an IOU imagined somewhere by some government, redeemable at some future date. No, it's real, it's now, you've already got it, you already scored the touchdown, it's in your hand. So that's what we in the stacking community understand when it comes to the true value of gold. However, I must confess to and for the stacking community that many of us tend to get a little too siloed in our thoughts here. We have to remember that we are a minority population, and while YouTubers that make stacking videos and those who comment on those channels are full of precious metals facts, none of which I typically argue against, and we also have no shortage of stacker bravado. We know the reasons why we're stacking. We also need to understand how gold really works. And today, I want to get to that. Part of understanding stacking, that is, why we stack, is understanding what works for and against gold and silver. So that's the topic for today. Government-issued treasury bonds, vampires to gold, the complete antithesis of holding physical gold, really, is the government-issued treasury debt, or the paper IOU. So let's dive in on that. Now, after falling to the high 1600s not long ago, once gold had reached its recent all-time high late last year, around August timeframe, gold has once more surpassed the $1,900 price level, and it does appear that gold is once more back on track with its 2019 to present bull run. Yes, that's right. Gold has been in a bull run. If you look back to June 3rd, 2019, gold's spot price closed at $1,325 or 580 US dollars less than gold is currently trading at right now. This does encourage most of us. You know, it's nice to see that gold is up. All right. But we are also seeing some renewed resistance from one of gold's natural enemies, the government-issued treasury bond. Bonds that generate a yield. Now, before we go further into bonds, let's talk about gold and the internet's reasons for owning it, because, of course, everything on the internet is true. So, per the internet, throughout history, gold has been seen as a special value commodity. Today, owning gold can act as a hedge against inflation and deflation alike, as well as a good portfolio diversifier. As a global store of value, gold can also provide financial cover during geopolitical and macroeconomic uncertainty. Sounds like the world today. So the takeaway is that people hold gold because it stores its value as the market value of currencies decline due to either financial or political influences. Gold is defense, it's insurance, it keeps your wealth safe. So now let's talk about what bonds are. And according to Investopedia, government bonds are debt securities issued by a government to support government spending and obligations. Now, here's the important part. Government bonds can pay periodic interest payments called coupon payments. Government bonds issued by national governments, such as the United States, are often considered low-risk investments since the issuing government backs them. And that's really just it. The United States says it's good. It's from the government, so it must be safe. I do want to remind you that you pay taxes on the currency that you earn, you pay taxes on the currency that you spend, and now the government is also gracious in offering you the opportunity to loan them back your already taxed currency, of course, which is considered currency because it's stamped by that government and we trust them. Of course, we do. And this same government will print money, more of it, more of this currency, that is, to pay you back in full for buying the bond. That, of course, at some predetermined future date. So when you buy the bond, you know when it will mature, but also they will pay you interest or a small currency payment along the way. That is the yield that we're talking about. Honestly, it sounds terrible to me, but people in large do trust their governments or their brokers to invest their currency for them in assets such as stocks and bonds. Bonds, of course, to diversify and hedge against the overall equities market by looking at the stock market. And when the stock market declines, we tend to see more interest in bonds and vice versa. However, you do lock up your currency for quite a long period of time in bonds. There are penalties often. So obviously, more traditional financial instruments such as ETFs help you get around this, but please do your research before considering bonds. Now, where it gets tricky for gold, even in a devaluing dollar situation such as the market that we're in today, is when the appeal of loaning currency to the government in the form of a bond purchase increases. That is, it becomes more lucrative as interest payments associated with that debt increase. Basically, the greater the return of the bond, the more appeal for that bond, and therefore the overall global financial market for gold, in theory, becomes less enthused as institutions, that is, and brokers and retail investors begin to move out of their fake paper gold and into this paper sovereign debt. It's important to note that it isn't really the bond yield, however, that increase in bond yield that spurns investors to move from gold to bonds. No, that's sort of a symptom. It is a reaction to rising real interest rates. So it's rising real interest rates that are actually the enemy of gold here. Real rates are nominal rates adjusted for inflation. In 2019, the real interest rates started their downtrend that we've been in the last 2 years. Obviously, the bull market for gold began at the same time. The lower the rates go, the better for the value of gold. And conversely, if real interest rates turn up again, then gold will begin to struggle. And we'll also see those increases in bond yields, which will sway investors away from gold. Essentially, gold may be swimming right now against the current at this time. While it's eager to rise in value on a devaluing US dollar, the monster that is the global financial system of governments can and does manipulate the returns on government bonds in order to control the supply of money and also influence the valuations of commodities such as gold. Folks, it is not in the government's best interest for you to buy and simply hold gold. The government benefits most when currency is moving, the speed of money, or when it is used to buy taxable instruments, especially those instruments that they can influence, that they can track and control. And physical gold, once in your possession, is no longer within their purview. So why would any government be pro-gold, other than, of course, to hold gold in its own vaults for the same reasons that you and I hold it in our small, piddly safes, bags, or pelican cases? The key takeaway here is, as you watch the spot price of gold change daily, you'll know that with some likelihood, as you see gold increase in value, that treasury bond yields are either holding steady or potentially declining, and vice versa. If the value of gold is in decline, then there is a chance, a fair chance that is, that treasury bond yields are advancing, supporting the most likely rise in real rates. Sorry for the background noise. Do have multiple computers around me. So if you want to keep an eye on US Treasury yields and the US dollar, I have posted 2 links in the video description section for you to visit and bookmark to watch the Treasury yields and their impact on the value of gold. So which way are yields going now? Well, I need a magic 8-ball to tell you exactly which direction they will continue on over a more macro time period, months and quarters. However, let's look back at January. And in January, we did open the year up with a real interest rate of negative 1.08%. And by February 1st, rates rose slightly to 1.02. That is negative 1.02%. -0.02. So pretty much unchanged. But in March, it does get a little bit more tricky. By March 1st, the real yield curve on the 10-year rose to negative 0.71%. So more than a quarter point increase. And by April 1st, we saw rates rise more to negative 0.66%. This is bearish for gold, as we did witness with gold's spot price decline from the 1900s to the high 1600s over that time period. Now, moving on from April, however, by May 3rd, the first business day in May, the real 10-year rate had once more fallen to 0.79% by May 1st, helping gold along. And as of June 1st, 2021, the 10-year real rate reached negative 0.84%. So you do the math. We're heading back down and we're seeing gold headed back up. Gold is an absolutely terrific store of value, but it is subject to the manipulations of the governments we pay taxes to. This is one of the reasons that I frequently mention to my viewers that gold is not a get-rich-quick play, or even considered an investment by many that buy and hold it, but more so of a true physical savings account. So let me know your thoughts on gold and the impacts on its value by real interest rates and treasury yields. I'd like to thank each of you for viewing today's video, and please do leave comments and questions down in the comments section. I'd also like to thank my channel members for their consistent support of my creative content. And lastly, if you enjoyed today's video, please do consider subscribing to the channel, and don't forget to hit the thumbs up before you leave the video, which does greatly support my work being offered to others across the vast YouTube algorithm. Thanks again, all. Do have a great day. Keep stacking, my friends. I hope you learned a little something, and we'll see you soon with my next video.